Hi, everybody. Barry McGuire here for Barry McGuire's Creative Real Estate Education Group. It's live at 5, the Monday main event. We meet up on Mondays and discuss all things around creative real estate. Donna and I do focus workshops, live events. We've done 3 this year already. Nothing in the can for the next little while, but we meet up for a day or 2, usually on the weekend, and have a deep dive into various strategies around agreements for sale and rent to own and wholesaling, fix and flip joint ventures. And we like to, bring on folks to talk about their areas of expertise. Bankers, insurance guys, developers, all kinds of people. And today we are going to have the third, actually, in our series with Garth Chapman and Neil Shopsowitz around the CMHC MLI Select program. Did I say that right? MIL.
MLI.
Yeah, MLI Select program. I'll get those guys mixed up. So that's CMHC probably implementing some government directives on making more money available for affordable, accessible, environmentally sound housing, better rates, better amortization periods, just better for investors. But the kicker is theoretically it's better. Now, why did we already have Neil and Garth on twice? Because firstly, the program was brand new and we were all pretty excited. Secondly, or the second time, we needed to get some updates on the plan and how it was working. But Garth reached out to Donna and I and said, "You know what? There's more stuff going on. More stuff. In fact, here's a whole list of things that are going. I think Garth gave me about a 10 bullet point agenda for things that he wants to talk about. So a lot of interest in this program. I have at least 2 clients right now who are in the process of applying for this kind of financing. We've put to bed 3 or 4 deals. Some have gone pretty well. Some have not gone very well. Some didn't go at all, actually. So I'm going to be very interested to hear what Garth and Neil have to say by way of updating for us, because there's lots to update. So let's get the lads in here. And for you folks who haven't, gentlemen.
Hi there.
Hi, how you doing?
Hey, boys. Well, as you can see, I got back from Europe. I still have all my teeth. We toured 5 countries in a couple of weeks. Did a real bus tour thing with a great driver and tour guide, and then we got to play 5 games of hockey against European opposition, which was a lot of fun. It was great hockey. It was a ton of fun, and I managed to be the oldest guy on the team and acquit myself reasonably well. Nobody yelled at me, and got back. So I'm really happy about that, because apart from creative real estate, there's nothing else I like more than playing hockey. So Garth, Neil, you guys have been on before, but not everybody saw the other 2 presentations, and not everybody knows exactly who you are. So let's start with an introduction of who you are, where you came from, what you did in your investing career, what got you to the space where I think you guys are kind of the experts in this field, just so people know who you are. Garth, why don't you start? Tell people about Garth.
Well, I guess in a nutshell, I came from Montreal where I grew up, to Calgary in 1970. I got involved in real estate in 2002 after, having a pretty good run and then having a bad fall where I lost a business. It taught me a bunch, and it managed to give me the opportunity to get into real estate investing, which is something I had wanted to do for a long time and didn't know how. I got involved with RAIN, which was helpful, very helpful for me. I met you, back then, early 2000, late 2002, early 2003, I guess. So we've known each other for 20 years now, Barry.
Yeah, yeah.
And I had more hair then. Yours was a slightly different shade, but other than that, you look the same. You're kind of immortal, and still playing hockey. Good Lord. So I got really heavily into real estate because I had to make up a lot of ground. I hadn't lost a business. I lost, most of what we had. I had good access to private money. We bought 90 properties in 6 years, from '02 to '07. We kept one for every three we bought, and with the other two we flipped to put food on the table. And we ended up with a nice little portfolio, and we bought apartment buildings and did condo conversions. We did a little bit of developing here and there, buying lots, separating them into two, getting development permits, building permits. I never did any of the building. I always sold that off to a builder because I thought the money at the front end was the sweet spot for me. We've still got a small portfolio left, which puts food on the table as designed. So that's my story. My wife convinced me to quit after we had bought the 90 properties because she didn't want to have another loss. We were too old to do it again. So she made me promise to stop buying, which I did. And I got bored and ended up in '09, became a mortgage broker with Gencor, with Croft Axon. And here I am, 15 years later, I guess.
Yeah. Yes, that was, you've had varied careers, Garth, and all's well. You spend a little time in the sunny South. I mean, you've got a place is it in Phoenix, or where are you hiding?
Yeah, we're there. We're here now, actually.
Okay, there you go.
We left on the last good day in Calgary, and here we are.
Now, Neil, you're, I know, a bit of your background, but as a lawyer, I think you were a lawyer and found that there were other better things to do than be a lawyer. Give us your background.
Well, I didn't stick with it like you did. But I was a real estate lawyer in Ontario for, I guess, about 4 years, through a very tumultuous period in the late 70s and early 80s. When rates went crazy and then the market crashed. After I left law, I was involved in several entrepreneurial type businesses involving franchising. I moved out to Vancouver from Toronto in 1996. Worked for a real estate development company for a while, and then ended up running a mountain for a while. And then I couldn't manage people anymore. I didn't have the patience for it. So I've been a mortgage broker since 2006. I've had CMHC correspondent status since 2008. So I've done a fair number of CMHC insured financings over my career. I used to do a lot. Then, probably for about 4 or 5 years, there wasn't really much point to doing them unless you really needed the extended amortization, because the spreads really shrunk between insured rates and uninsured rates. Yeah. But with the introduction of MLI Select, there's been a real resurgence in activity on CMHC insured financing. So that's probably about half of what I'm doing right now.
All right. So yeah, resurgence is a good way to describe it. And so you guys have been on a couple of times. We talked about, the intro and all the enthusiasm, and then coming on again and going, well, there's a few things here and a few things there that need to talk about. But you've got quite a list. I didn't count up exactly the number of points we're going to talk about. But Garth, if you were leading, why don't you dive right into to your list of things that we should be chatting about today?
We can do that, Barry. In reality, we always like to send you a little short laundry list so that you can work with that and ask your questions as you like, or we can just run with it and you can interject with your observations as you prefer, if that's good.
That's good.
And I'm interested to hear, maybe you've got some stories you can tell us about those deals you mentioned in your intro, some of which didn't happen, some went well, some didn't go so well.
I will.
Neil should talk about in a little bit here. He should talk, I think, about one that he just escalated at CMHC because it had been sitting for so long, and was successful in that escalation after 2 calls at the supervisory level. So that's nice when when you're working with a guy who can pull that off. So our client is undoubtedly ecstatic today after many weeks of waiting.
So let's not skip by that, Garth. Neil, you just kind of quickly ran by your status at CMHC, which is likely why you could make the call and do the escalation. Tell us what status you have there and why it's different than what some mortgage brokers have.
Well, I can go direct to CMHC, get the certificate of insurance, and then go to market and get the best deal out there. Most mortgage brokers have to work with an approved lender.
Right.
They may be one of 100 files that the lender's working on. Where I might have 10 files, so I'm going to be a lot more focused on getting a positive result for the client and fighting with CMHC to get the maximum loan possible.
All right, folks, that's a really important point about why you should be chatting with Neil and Garth when you're looking to get one of these CMHC MLI Select loans. Very important. All right, Garth.
It is. So I think the first thing we'd like to, the first topic we'd like to cover is the turnaround time with CMHC, which prior to June 19th, when they announced, I think in April, that on June 19th, the premiums were going to be increased and nearly doubled. So this is not the rates, this is the premiums that you pay to get the insurance. That landed, I think, Neil, was it somewhere around 3,500 files hit them in that week?
The last week, where they normally get about 300.
Yeah,
and they've never caught up since. Turnaround times. When you submitted an application, it would normally be reviewed within 2 business days. An underwriter would be assigned within 3 to 4 weeks. You'd get the COI within a week after that, if everything went smoothly. Commitment shortly after that. So, you're 8 weeks start to finish. Right now, when you submit an application, it could be a couple of months till it's even just reviewed. And then you've got a long wait for an underwriter, potentially up to another 5 months. And then you've still got to go ahead and get your COI and get a commitment and then go and get funding. So they're trying now to prioritize new builds and purchases. And I think, that total timeline's down now to about 4 months, 4.5 months. Refinances take a long time. They can take 5-6 months. They're starting to make a bit of headway, but we're heading into December, and it's 30% of the people are going to be on holidays any given time. They're going to be shut down for a couple of weeks. So I think that backlog is going to creep right back up again. They are apparently trying to hire more people, but it's not a quick process.
So big issue for people to understand what it might take to get an approval. I'm sure nobody really understands that because of the premium raising and the onslaught of applications that the timeline is so extended now. So let's just give people a little nugget here. If somebody is looking to do a new build, and they want this kind of financing, and they want to say how long they need to get the financing, what should they be putting in their contract?
Well, on a new build, the challenge is you can't apply till you're permit ready. So that takes time.
Yeah.
And then they're probably looking at 4 months, 4.5 months to get an approval. And then, so you wonder why there's a housing problem in the country. Mm-hmm. Particularly rental housing.
Yeah.
So
it just takes forever.
Yeah. Now on the new build side, Barry, it's less impactful in the sense that there's so much that you have to do as a developer to get this thing ready. So once you've got your development permit, there's still lots to do. Neil will always say he's not going to submit a file unless he's pretty certain it's going to get approved. So if you're pretty comfortable, and we're very comfortable, Neil especially comfortable with your file, then we have clients who are knocking down the old building, digging a hole, getting started, so that when the approval hits, when the COI arrives, they're already partway into it.
Yeah.
They've
Yeah,
got
and you'll
some
get the
capital,
money
so they're
back on
deploying
it.
it.
You'll get the money back on your first advance,
Right.
you know, or a lot of it.
Okay.
The other challenge just with the time, which is a problem. I mean, now it maybe not so much because rates have peaked, but an application that I submitted at the beginning of June that's, you know, finally got an underwriter today. You know, the ceiling rate that I would have put in June is a lot different than what the rate's going to be today when the thing gets funded, which means that the borrower is going to likely have to buy down the rate or take a smaller loan, one or the other.
Yeah.
And that can be quite impactful,
Yeah.
especially on a larger loan.
I just did a little analysis today to that point. Back in May, Neil, you were using, for underwriting purposes, I think you were using 4.5%.
Right.
And today you're more like 5.6.
Right.
So on a $2 million purchase, the difference of 1.1% in those rates is running about 11 or 12% impact on the loan to value. So if you were buying an existing building, and you know, in May, the rate at 4.5% would have, let's say, delivered in that particular building's case, let's say it would have delivered an 88% loan to value. Today, it'd be 76% or 77%.
Yeah.
That's a big, big difference.
That's huge.
Right. And same on construction. So if I'm submitting a construction file now, I've got to use a higher ceiling rate than I was using six months ago. So, you know, in theory on MLI Select, you can get 95% loan to cost, but in reality, it's going to be closer to 85%, you know, or 82%.
Big chunk.
Yeah.
Yeah, we were, and in the spring, we were nudging right up against that 95%. In Calgary and Edmonton, a little bit less. And there, you know, there can be deals out there that'll hit those ceilings, or used to, at those lower rates with experienced developers, maybe with low land costs, especially. That's a big component. But those are gone now until rates come back down, which we hope will happen at some point here, but it may be a while.
Yeah. I mean, it was quite surprising, you know, with Bank of Canada standing pat in the last inflation report, that the bond rate really didn't move.
Mm-hmm.
Yeah. It's been steady now for a few of the rate setting days.
So that probably leads us into, and this is out of sequence a little bit, but that's fine. I think that leads us to bridge financing options, because when you're buying existing assets, you're unlikely to find a seller that's willing to give you 5 or 6 months for a condition period. So there are, you know, experienced buyers are out there achieving bridge financing. So it's shorter term money to close the deal. And often then they'll use that time, you know, it might be a 1-year loan, for example, and use that time to stabilize the property, bring the rents up, bring your expenses down, then refinance it into MLI Select. And you might have bought a property with a 70% loan to value and turn it into something that's approaching 90, or perhaps better, or a little less.
Sure.
So you can then, you know, stabilize the building, do the refinance. You will have had 2 sets of costs, because at the closing, you've got legal fees, you got broker fees, you got a lender fee. On the refinance with CMHC, you've got some legals again. You've got a bit of a broker fee again. You don't have a lender fee at that point, because we're submitting directly through Neil's ability to deal directly with CMHC. There's no loan fee there. But you do have some costs. But if you're bringing the value of the property up such that you're picking up, you know, 10 or 15% on loan to value, that has some value. And you've got to absorb those costs and the higher interest rate for that initial period. But it's certainly being done and is doable. And it's something that Neil offers.
Yeah, the only caution, there's 2 cautions on that. One is that the bridge financing's got to be with an approved lender.
Mm-hmm.
And then the second thing is that when you do the refinance, if you're taking money out, you've got to put it into another property, you know, or put the money into an existing property that you have that's 3 or more units. You can't just take money out and put it in your pocket.
Yeah. Now, having said that, though, all the money that you spent on the acquisition cost of the property, all the money you spent on improvements, presumably the closing and acquisition costs on the front end, all of that you're entitled to take back and replenish. But anything above that and beyond that must be reinvested in properties that you either already own that are 3 units or more. So they don't have to be multifamily. It could be a triplex, fourplex, or it has to be invested in acquiring additional properties. Again, 3 units or more.
Yeah, there's one other option also, which may work in some cases, and especially depending on the time of the year, which is to get the vendor to finance it.
Mm-hmm.
And that, for example, if you were buying a property at this time of year, it may be advantageous to a vendor because they can defer their capital gain on the portion that they provide a vendor take back on.
Yeah.
Until you pay it out. And that's the least expensive option for you as a buyer, because you're not going to pay for an appraisal, you're not going to pay legals, you're not going to pay broker's fees or lender's fees on that. You don't have to pay that until you end up doing your refinance, and that's acceptable.
Okay. And folks, as you're listening, considering the cost, it doesn't hurt to talk to your vendor about whether or not he might carry some financing for you as you work your way through. Worst he can say is no. God damn it, I'm not a bank. But
yeah, the first thing to do, I would say the first thing to do is talk to your broker, talk to your commercial mortgage broker, and make sure you understand what that financing needs to look like. So it's not like you're going to get a 10 or 20 or 30% vendor take back in terms of loan to value and go find the rest of the money somewhere else from your uncle or from a private lender. That's not going to work, because again, it needs to be an accredited lender or the seller. And Neil and I did a deal middle of last year, which was exactly that, where the vendor carried all but the initial deposit, and Neil put together the MLI Select Mortgage, and we closed the deal.
And so I'll say again, Garth, we were talking about examples. I just closed the deal where my seller carried 100% of the financing. So it's, it is out there. Now, Garth, you also said when you started that part of the conversation about bridge financing for an experienced developer, my mind is going, okay, I can just see people who are just getting started in the multifamily sphere and don't really have too much real estate experience anyway, thinking they can just, dive in and do this. I mean, to my ear and eye, I'm saying, folks, you probably should really be consulting with Neil and with Garth on what your plan is for a particular property, because it's all got to work. You're buying and bridging on the understanding that you're going to get CMHC takeout financing down the road. So that was easy to say. That was 20 words or so, but to be able to make that determination is a whole other matter. So again, consultation and setting up a plan is absolutely well worth doing.
Yeah, and we don't charge for that. I mean, we're happy to help people understand what they need to do. And to your point, Barry, going back to what Neil said, for an experienced operator, they don't need to get the appraisal at the point of closing with the vendor take back. Excuse me. They don't need to get the building inspection. But if you're new to this, you better get both of those, in my view, because you don't really know what to expect. You don't know what you're looking at when you check out a building. You better have an inspection, I think, and you probably want to get that appraisal so you know what you're going to expect to see in 6 or 12 months when you do that refinance. And what we can also do is help you with, you run a pro forma as current and a pro forma stabilized, and that's what you're going to refinance into. And Neil will be able to give you a pretty good idea if those figures in those two pro formas, if they are realistic, and because they're going to determine mortgage amount.
Yeah.
All right. So
okay, that's good.
I think we should lead into the next thing that's changed over the last 5 or 6 months, which is size of loans, especially on new builds. which I think affect the bulk of investors who are looking at first-time projects. There are very few lenders now who will do construction loans under $5 million, insured construction loans. They just find there's no money in it for them. It's, a lot of hassle. They're finding that the smaller developers are the ones who tend to have the most problems on their deals, as opposed to the experienced developers. The lender pool is small, and under $2 million, it's really small. The lenders who will do it, or the lender who will do it, the lender fee on the construction loans has gone up considerably, and the rate is higher. And these are things that need to be budgeted for, and they require a QS. So, what's your option if you don't want to use an insured loan for your construction? You can always do it conventionally or privately. Privately you may run into the problem that it's not an accredited lender, and you can't do a MLI select or an insured takeout. And if you do it conventionally, it's going to be underwritten on a 25-year amortization at conventional rates. So, instead of getting 85% loan to cost, you might only get 60 or 65% loan to cost.
Okay, that's important to know. We've got a few questions accumulating. We got some popped up there. Let's get through those so we don't have 30 at the end.
Sure.
To your point on approved lender, have you seen some CMHC approved structures which involve a private lender debt partner, i.e. share pledge or special shares, so it shows on the share registry?
It's creative.
I have not seen anything like this for my files.
I've never seen that either, but that could work. If they're a shareholder and they're being taken out, and it's being positioned that they're being taken out, I don't see why it wouldn't work.
Yeah, well, that might be something to explore, Facebook user, if you want to keep things flying along. And if you're operating at the level where you ask a question where our two esteemed guys are going, they actually haven't seen that, but they think it might have possibilities, then you should probably have a private chat with them to see whether or not they can help.
Yeah.
Sam, what did Sam say? Refinance with CMHC. Do we need a 2-year stabilized rent roll?
1 year.
Oh, excellent. 1 year. Okay.
Well, sorry. On MLI Select, you don't need anything, right? The premium's a little bit different. If EGI is not, the premium is depending on the loan to value.
There's no rent up requirement on MLI Select.
Yeah, the premium difference is 65 basis points.
Okay. All right. That's Sam's question. Donna, was there one more? Can you refinance from VTB financing straight into CMHC, or do you have to refinance into an approved lender first? That's a good question.
No, I think you can refinance straight into CMHC. We've done one not that long ago.
Yeah.
That was the exception to the approved lender is
Right.
vendor take back financing.
Yeah, right.
Okay. So that's also a good question. We got a group that's on it today. This is good.
Mm-hmm.
All right. That was the 3 questions. Let's get on with the next point that we think is the one.
I think challenges, as Neil mentioned, lenders turning away from smaller loans. That's not only the case in terms of construction loans. There are lenders going so far as not to renew existing mortgages because they're smaller than their newly decided minimum loan amounts. We're seeing that. The CMHC is scrutinizing deals more conservatively than in past. Neil, can you speak to that a little bit?
They're very thorough on their net worth scrutinization in particular. They're also very focused on vacancy rates, any divergence from their cost standards, you have to provide the backup to show, why your costs are lower than what they have in their standards. One of the frustrating things, and I know we mentioned this later on in the notes, but that can be very challenging, is there's not necessarily any consistency
Right.
when you're dealing with the underwriters as well.
Yeah.
on these kind of points. You have a deal in Edmonton, your underwriter could be in Montreal, they could be in Halifax, they could be in Calgary, they could be in Vancouver, they could be in Toronto. And they have the independence to look at the property and come up with their own conclusions. So, we just went through this where we had an underwriter who was in Montreal, and there was just no way I could convince him, even though we've done half a dozen other deals in Edmonton recently where vacancy rates were 5%, and he was determined that it was going to be 7%. And there was nothing I could do about it.
No.
We fought. I tried to go over his head. I couldn't get anywhere. The way one guy might look at net worth might be completely different from the way someone else might look at net worth. So that can be quite challenging and quite frustrating.
So that's
really, and the lesson, if I could just jump in there, Barry, the lesson
Sure.
on that, to my view, is ideally we want to see borrowers who are somewhat overqualified. So if your net worth requirement is $1 million and you're at $1.3 million, good. If you're just barely at $1 million, I hope things go well. So all of those criteria, how much capital you have, your net worth requirements, beyond that for the guarantees, etc. Numbers, given what Neil has just said, I think that makes that much more important.
Yeah, and in terms of surprises, and I just had a real surprise. I've been waiting for about 3.5 months for an underwriter on a purchase, and one day the COI, the certificate of insurance, just showed up in my inbox with no introduction, no questions, nothing. So again, you talk about inconsistencies.
So there is two things coming out of that. There's a wild card factor with underwriting, with which underwriter you get. So a bit of a wild card factor, and generally speaking, those underwriters are going to give all supporting documentation and information a real good going over. So, be real, folks. Be real, and because if you're not, you'll just get it thrown back in your face. So wild card and tough underwriting.
Yeah, which was when they made their announcement about the premium increase, the excessive or extra scrutinization in underwriting was cited as well.
Yeah. Gotcha.
So that leads also into budgeting changes, again, for people who are looking at new builds, because that's part and parcel of the same thing. You need to budget more for lender's fees. You need to budget more for interest. You certainly need to budget more for contingency now. Not that long ago, 6% was the standard. Now it's 10 or 11 on hard costs.
That's big.
Yeah. Fees on those smaller deals. The lender fee on the construction mortgage was what was it, Neil? 1%. Now it's 2%, with a minimum of $50,000, I think.
Yeah.
The rates were running prime +1. They're now prime +2, and that's all happened in the last 3 months.
Yeah. The only good thing is that there's no new GST. No GST now on new builds.
Right.
Of rental properties.
So that's excellent.
And it's a big number.
Don is bringing in a couple more questions. What is the smallest project that could qualify for MLI Select in terms of property size, type, and dollar value? Sorry if I missed this earlier.
Okay. I think if you wanted to do a project of that size, if you could pull it off, maybe you could do it with a 5-plex in Edmonton, might work, or maybe Lethbridge might work. but it's going to be expensive. You know, it'll be the same $50,000 minimum lender fee, you know, and the prime plus two, and you still need to get a QS, quantity surveyor. So it will be expensive. And you know, small projects in small markets, I just don't think are going to fly anymore.
It's going to be tough to find a lender, both for the construction loan and the takeout's not easy.
Yeah, they just don't want to do small loans. So another reason to check and consult before you spend a whole bunch of time and money and effort on your dream multi.
Yeah,
Okay,
I mean, I don't think you want to be doing an insured construction loan, you know, much less than $1.8 million, $1.9 million.
Yeah.
$1.8 million, $1.9 million. Okay. What can you use MLI Select to purchase new construction from a developer? They work on a 200-unit tower, and I purchased 5 units for $2.5 million. I think so.
They don't like, you know, CMHC lenders don't like fractured developments.
No. They will do a complete floor. If you wanted to buy the third floor, you might get that done.
But then you've got to get, you know, agreements, you know, as to how you're going to have, you know, the common area maintenance work and how you're going to share access. And, you know, I mean, it's complicated. I mean, the ones that we've done that are, you know, a lot more straightforward is you have a developer who's doing a 200 unit townhouse development, and you want to buy 5 of the townhouses or 10 of the townhouses and operate that as one project. That's fine. And that's very straightforward.
Yeah. They need to be contiguous. They need to be side by side.
Yeah. But to buy 5 units out of a building would be really tough.
Okay. Good questions, you guys. Good questions.
Very good.
Donna, any more, or are we heading on to our list?
Do you want to do one more? Or
Well,
do you want to
sure.
Yeah.
Sure, let's do one more.
All right, there you go.
Corey. Oh, Corey, you were thinking, I'll never get my question answered. Neil mentioned rates may have peaked based on the Bank of Canada's bond stability since the rate hold last week. If more rate hikes were coming, would we see Bank of Canada rising? BOC. That doesn't mean. What does BOC mean in this?
Bank of Canada bond rates are supposed to be a bellwether as to what's going to happen with the Bank of Canada.
Yeah.
You know, if we saw bond rates start to spike again, you know, I think there'd be a good chance that you'd be seeing the Bank of Canada raise rates maybe another 25 basis points. I mean, most people think it's done now, and the damage has been done, but you know, you never know.
No. All right, what's next on the list, gentlemen?
Well, I think really we've done a really efficient job of covering all this. What I've got left, I guess, is that we should talk a little bit about, especially for newer developers or newer, you know, entrants into this multifamily sphere. I think the keys are, you know, having a good team around you. You need an experienced commercial realtor who can help steer you to the right stuff. And what we offer with a very quick turnaround is, you know, in terms of our service, beyond, you know, some consultations when you get started to give you a sense of what to expect and how things work. And after an initial call, I will generally send a set of emails. I have a number of template emails that are, you know, based on with different subjects. And I might have 30 of them, but you only need 6. And Sally over there, she needs those 4. And Joe over here, he needs those 8. So I'll do that after those initial calls or 2. The other thing that we'll offer is bring us the building that you're looking at. Once you've established what your criteria is, which you can chat with us about, and we can give you some comments. Once you've established your buying criteria and you've delivered that to your realtor who is experienced, they need to be experienced commercial realtors to really serve you well. And then when you find properties that you and your realtor think make sense, 1 or 2 at a time, send them to us. Send us the listing, send us the pro forma. Ideally, send us the rent roll if you're aiming for MLI Select, because rents individually per unit are important. And within 24 hours, we'll send you a financing estimate. And if there are current figures in a pro forma and stabilized figures, that report will give you both. So we'll determine maximum mortgage amounts, both current and stabilized. Neil will adjust the pro forma in terms of the expenses based on what CMHC's lending requirements are, because they typically, many of those numbers will not match what the realtor, the listing agent has on the property in the pro forma, and that's just always the way it is. That's standard. Theoretically, what's in the pro forma should be real world numbers, and what we've got to underwrite at, what Neil has to use when submitting to a lender and or insured mortgage through CMHC, those underwriting figures for various of those expenses will be different. Some of them will be missing entirely on the pro forma because maybe you won't have that expense, but we're required to utilize that in the underwriting. Neil, can you speak to that a little bit, maybe?
Well, it's basically as you said. I mean, most realtors, their pro formas are a bit inaccurate and a little bit optimistic in terms of what financing will look like. And there's once you've seen a few of them, also if you're looking at properties, you'll start to get a feel for it. Also, like if you don't see anything for management because the person self-manages. You don't see much for repairs and maintenance because they didn't have any in the past year. I mean, you start to get a feel for it after a while. Yeah. But I mean, the other thing I was going to say, I mean, people are still doing stuff, and I mean, the only thing, cap rates have not changed much. Right. But particularly on the construction side, people are doing things, and people still have to refinance, and. Garth touched on that. I mean, there are lenders now who are pushing loans under $3 million or under $2 million out of their portfolio, period. And those need to be refinanced. So, I mean, there is activity on the construction side. I've been doing more conventional construction loans again, just because of the time factor. And if the person's got the funds available, to handle it and then wait till, they're done to get the money on the takeout. It works perfectly well for them. But it's not as if activity's dried up. It's just different.
Yes, things are always changing in this business. It definitely doesn't stay the same. And this is a classic example of, just give me 1 second. My producer is eyeing me. Yes, Donna?
No, you're fine. There's just a couple more.
Couple more questions today. Okay, we'll get to those. I was wanting just to say to people, Garth talked about lenders sending you a note that says, "Yeah, your mortgage is coming up for renewal, and you've been a great borrower. We love you, but we don't want to be your lender anymore because the loan is too small." Whatever the reason is, folks, lenders. It's a common failing amongst investors to think that if they have a mortgage with a lender, they'll always have a mortgage and it will always be renewed. Well, that is not true. And here is just another example of why lenders will send you that shocking letter that means you got to go get different financing because you don't have a loan with them anymore. So that's important to remember.
But the fact that you have, if it's an insured loan,
yes,
CMHC insured loan, you have some security there in the sense that as long as you have been performing well and everything looks good, your broker will be able to find you a lender to replace that one.
Okay.
Generally speaking, I can't think of a.
You just can't let it go too long, though, Garth.
Yeah. Yes. Good point. Let's talk about that.
Okay.
We have an example that we don't need to talk about the example, but
Neil?
We have seen that happen.
Give us that example.
Well, no, I mean it's just the loan matured. The borrower didn't make provision, for even a 6-month rollover or a 1 year, a short-term rollover, and the lender just didn't want the loan on their books anymore because of the loan size, and they basically started collection proceedings, enforcement proceedings.
Wow.
Yeah, and they've been very difficult.
Yeah.
So the lesson there, as always, it always comes back to this, doesn't it? Get on the phone, call your commercial broker, and say, "Hey, this is the letter I've got. What do I do?" right? And if you don't have one, find one. Call your favorite real estate lawyer and say, Barry, who should I call on this?
Yeah.
This is what I've got. I don't have anybody. What do I do?
Don't delay.
You know,
Do not delay. Call now,
Yeah.
as they say. We've got a couple of questions, but just before we get to them, a little sidebar. I've been observing I live in Edmonton, and in my area of Edmonton, there are, it seems to my eye, endless numbers of wood frame walk-up apartments that are being completely redone.
Yeah.
Now I'm saying to myself, part of it might be the MLI Select program that people are taking advantage of. The other thing is, and this is a sidebar, that I think there's a big push from our property insurers, not CMHC as an insurer, but property insurers who are also looking at their portfolio of insured properties and going, you know what, we got to be a lot tougher on our owners as far as upgrading the plumbing, the electrical, the HVAC, the windows, the roof, because our claims experience has been bad. And so we're going to make owners put a whole whack of money into their buildings. So I'm seeing a fair bit of that around, and it's maybe a factor that works into what we're talking about somewhere along the line here. Insurance is tough these days, in all respects.
It's very expensive.
Very expensive.
And I think people are going to be shocked when they renew their insurance next year.
Yeah.
Mm-hmm. Well, I had a little fourplex that basically tripled in the insurance tripled in 6 years. Just went through the roof. Questions, Donna? What do we got? Glidra says, why the lenders don't like Airbnb income versus yearly leases? Oh.
Because you're running basically a hotel. That's how it's viewed. Short-term rentals, or a hotel or accommodation business, as opposed to a stable rent business. So you can't do it on an insured basis, and there's not many conventional lenders who will do them. There's the odd one, but not many.
The hotel business that is viewed very differently than the business we're talking about by lenders. Very differently.
Yeah.
Right. Next question, Donna. Sam's just been sitting there thinking. He's got these two guys cornered, and he's going, all right. If we build the eightplex under ABC development with a conventional lender, after completed, we buy the eightplex with DEF Holdings Ltd. Will this be more clean for CMHC and solve this issue with equity takeout? Easier to get loan to value of 95%, cut down time and questions on improving the mortgage. Do you see any downside with this method? So we're going to build under one company and then sell it to a different company, it sounds like.
Well, so I'll just jump in to say what I think Neil is going to say, and then he can jump in and go to the nuts and bolts of it. But, the lender and CMHC would look past the corporation to who are the shareholders, who are the minds behind those two corporations. If they're different people, that might work, obviously. But if they're not, then it's all one and the same.
Okay.
Neil?
Good point.
That would be my answer. Common ownership, if they look to the ownership of both, it's going to be seen as an equity takeout.
Yeah.
Wonder, is there a situation where ABC might actually bring new people into DEF so that there's some of the same ownership, but not, there's truly a change in. Is that a matter of percentage and further analysis?
Yeah. Do people understand why that equity takeout rule was put in, or when it was put in?
Let's have a repeat of why.
Rates got down very low, like 1.5, 1.6, 1.7 on insured loans. People went to refinance and they could take a ton of equity out and just put it in their pockets, or do whatever they wanted with it. And that wasn't what CMHC or the government wanted to see. they didn't want people pulling money out just to pull money out when rates were low to stimulate the economy. They wanted money going into new projects,
Right.
or to their existing projects. So that's when they tightened it up.
Yeah.
Right.
Well, and that happened in May of 2022, and MLI Select was announced only a couple of months before that. I think it was March.
Yeah. Yeah. I mean, stopping vast sacks of cash coming out on an equity takeout. I mean, that falls, it runs afoul of the why we're doing this with CMHC and why the government is doing things. So it makes perfect sense from their perspective, for sure. Donna, do we have any more questions?
We do.
Okay, let's see what we got here.
Uh,
Corey, where does CMHC get its cap rate for underwriting? Rental surveys?
They don't really use it.
They don't use it any. They used to have. You never needed an appraisal for anything unless it was a 6-plex or a 5-plex.
Yeah.
And they had their own internal cap rates for every market in Canada. That changed. Now you need an appraisal for anything up to 24 units. And then, they're looking at net operating income or net operating income pro formas to determine what loan amount they're going to do.
So really, it's a matter of, we'll do the underwriting, and they will, they will do the underwriting as well, but we'll do that on the submission in terms of what the actual net operating income is as per CMHC's criteria, and that net operating income in a magic math formula together with amortization and interest rates determines the maximum mortgage payment per month that the building will support. And then from that, you get the mortgage amount.
It all makes sense mathematically.
one more.
One more question. MLI Select, can the rent be increased under affordability, and to what amount? I'm not sure I understand that.
Can you increase once you've got your baseline, you can increase your rents by whatever the province allows, and if there's a province that doesn't have rent control, then it's CPI.
Okay.
And CMHC is a couple of years behind in terms of updating those figures that are the median renter income in each large city and medium-sized city is there is a figure for that, StatsCan figure. And CMHC then breaks that down into a list, which is available online. And if the town isn't big enough, then it goes under the rural figures for that province. And so your rents, your maximum rent under the affordability criteria is calculated that way. But the numbers are actually from 2019. And here we are near the end of 2023. And we're told they're working feverishly to update this, and we've been told that for more than a year.
So right when we're experiencing the first bit of inflation in a long time, and it's gone crazy enough to cause all the rate increases, we have 2019 figures.
Yeah, and it's really not in their interest to update those figures and drive those rents up. That's not what they would like to see, probably.
Sure.
But they use the same number, whether it's a bachelor, 1-bedroom, 2-bedroom, 3-bedroom.
Yeah. So in Calgary, your number is what, about $1,730 a month is your maximum rent under affordability. And just for contrast, in Red Deer, it's under $1,000.
Wow. Holy smokes.
Yeah.
So
Edmonton's 16 and change, Calgary 17 and change. That's why those are the two hotspots, because those numbers are really, they deliver cash flow.
And that's why those 8-plex models work so well, where you have 4 up and 4 down.
Yeah.
Because it's pretty easy to make 2 of the 8 units if they're 1-bedroom, down suites, at under $1,600 or $1,700 a month.
Yeah.
So to get your points, you're earning points under MLI Select, and if you're doing it all on affordability, you only need 25% of the units on a new build to be set aside as affordable units, and over time those particular units can be changed. On an existing asset, what is it, Neil? Is it 40%? of the units.
40% to get a 35-year AM.
Yeah.
You know, and for, you know, again, using Edmonton as an example, and, you know, as you noticed, you know, most apartment buildings were built in the 60s and the 70s.
Yeah.
You know, so you're not likely to get more than a 35-year amortization anyway. So there's not really any incentive to do more than 40%. You know, you can do 60% to get 40 years or 80% to get 45 years, but there's no real reason to do it.
Yeah. Okay.
Question.
Lots of stuff going on. All right. Francis says, what is CMI?
I think he might be asking what is CPI, which Neil referred to as your allowable rent increase if there are no rent controls in the
So the
province.
consumer price index, rate of inflation.
CPI is Consumer Price Index, which is really, as Neil says, the rate of inflation.
Okay, there's two more questions.
Two more
I'll try and
questions.
get them under the wire.
All right. In this current environment, are you seeing a trend or commonality with deals that are working better than others for investors, developers?
I think I mentioned the front points.
The common, you know, for small investors, the one that works best is that 6-plex, 8-plex, 10-plex model, 12-plex model, because of the affordability, and it's so easy to meet in markets like Edmonton and Calgary.
Yeah. Seeing a lot of those. Seeing a lot of, 6, 8, 10 plex things that are going nicely for people, for sure.
Yeah, you know, you can buy the land for $300,000 to $400,000, which, you know, works quite well.
You're probably more like 6 to 8 in Calgary in many areas that we're seeing, but Edmonton's quite a lot lower.
Yeah, but Calgary, the underlying rents are higher, so
Yes,
you know, the
that's right.
numbers work.
Numbers work. Okay.
Last question.
Last question. Here we go. Sam, I think it's only 2 per customer, Sam. 2 per customer. What's your best advice for us who are small investors, loan size under 2 million, who want to build with CMHC construction loan? How do we prepare ourselves best to make your job easier and get the CMHC loan? So, okay.
Just call us.
Well, yeah, I mean, you know, you've got to be realistic with your budget, you know, is one thing. And, you know, you've got to look at the additional costs that you're going to incur now, you know, based on what's going on. You know, I mean, and you got to stick to major markets. You know, like if you're thinking you want to build something in Brooks, you know, or Trochu, it's not going to work.
Okay. So for Alberta, are we talking Calgary, Edmonton, Red Deer, dare I say Fort Mac?
Yeah, Fort Mac would be okay. Lethbridge, you know, would be all right. I mean, you know, those would work for sure.
Well, gentlemen, my goodness, there's always so much to talk about when you come on and talk about this program. Stuff going on. But, you know, Garth, you said to Sam for his question, call us.
Yeah.
Call them.
Because we really don't know how far along that road you are until we have that call. And we don't mind that, you know, 30, 40-minute call on Zoom to put a face to the name, get to know you a little bit, ask the right questions, get some answers. And then we can steer you to what you need to do, what you need to adjust, and all that kind of stuff. The other thing I wanted to say, I just noticed my email address up there. Donna, that's the old one for GenCore. We're going to want, it still works, but ideally we'd like people using the Garth@mortgageconnection.ca email for me.
Garth@mortgageconnection.ca. Rolls off the tongue, doesn't it?
It does now. It's been 6 months, so I guess, yeah.
All right, guys. Well, listen, it's. I just love having you on. There's such a depth of knowledge. I hope we haven't beaten your drum too hard here to say, call them. That's that's an easy thing to do. Why struggle and screw yourself into the ground when you can take what you got in your brain and call Neil and Garth and have them very quickly sift through what you think you're doing and put you on the right track, whatever that track might be. There's no charge to this, remember.
Exactly.
It's only time.
Exactly.
So,
and I'll clarify that by saying, don't call us. Send us both an email asking for a call and tell us what days and times of day you're available, and we'll pick a slot and we'll book a Zoom call.
Much better idea. Much
Yeah.
better. Much better.
Good.
Gentlemen, couldn't do it without you. This is great. I just love these sessions. We just blasted through an hour and I had no idea it was that time. But the producer's giving me this, so
There we go.
right.
Thank you, Barry.
You and Donna are the best at. You always end exactly on time. That's impressive.
people like to start on time and finish on time. They do.
Indeed.
All right,
Thank you
guys.
both.
See you later.
Yeah, thank you.
Good night.